session. I'm delighted to welcome Dani Rodrik and Dirk and Nick to this meeting. I wanted to say something first, of course, about Dani, who, for development economists, doesn't really need much introduction because we've all been reading him for such a long time. And I will only tell a very quick anecdote. When I had my 20th wedding anniversary, I persuaded my husband to take me on a little holiday to a beautiful place, but I made the mistake of putting Dani's latest book in the suitcase. And I spent most of that holiday reading the book, much to my husband's annoyance. The point being that his work is so interesting for us development economists because he deals basically in a very insightful way with all the big issues. So many development economists deal with one small part of the issues, and he deals with the big challenges and always in a very, very thoughtful way. And the two commentators also fall in this category because Dirk has been leading very important work on structural transformation and on other key issues of development here at ODI and built up a fantastic portfolio of research. And Nick has been supporting this from DFID. And I think DFID needs congratulating on again supporting this meaningful research, which is important for researchers, but particularly important for policy. And so I'm about to say, to give the floor to Dani, who will be speaking for half an hour, then Dirk will speak for 10 minutes, and then Nick will speak for 10 minutes, and then you, the audience, will be participating through questions and answers. And we have a big audience outside the room because this event was heavily oversubscribed. So without further ado, we will start. I just wanted to make perhaps 2 points. One is, I think the discussions that we will have are very important, but perhaps one dimension that is often not looked at is the scale of the countries that we're talking about, because the kind of development strategy that you can pursue is different if you're a very large country like South Africa, or of course Brazil or the other BRICS, or if you are a small African country. And so therefore the thought for that and the importance of and the difficulties of regional integration. And the second, which I think Dani will also refer to, is this whole issue of mediocre growth. To what extent developing countries may be facing a greater slowdown in the world economy to do with Europe and with other factors, which poses, I think, even more difficult challenges. And the final challenge, I think, is to make this growth much more consistent with the needs of limiting climate change. So these are 3 issues that kind of worry me, and I don't want to preempt the discussion at all, and I'm absolutely delighted to give the floor to Dani.
Thank you very much, Stephanie, for that gracious introduction. It's really nice to be here at the ODI. Thank you, Dirk, for the introduction, for the invitation. And I'm going to be talking about growth. Let me be clear about that. Development is not all about growth, but that's what I'm going to be talking about. And I'm going to be talking about the role of structural transformation in driving growth. And for me, it's as I've been putting these notes together, it's really a sort of a quite unsatisfying kind of conclusion that I will be ending up with, because I'll be left with pretty much a conundrum, and maybe the discussion afterwards may help us get out of it. I'm basically going to argue that that the fundamental engine of growth that has driven very rapid convergence, rapid economic growth in the past in those countries that have been able to pursue it, is running out of steam. That fundamental engine is industrialization. I'm going to give a rather depressing message on that the future prospect for industrialization are fairly dim, even for low-income countries where wages are low and where you would have thought that they have lots of potential in export-oriented manufacturers. That'll lead me to look a little bit at the prospect for productivity growth in services, where most of the employment will have to come from in the future, as in fact they have in the recent past. I will not find a lot of sources of optimism there either, which is where the sort of the conundrum comes, and I'll be ending on a rather pessimistic and puzzled note. Let me begin by very briefly laying out a perspective of sort of how do I think about growth. And my sort of general perspective on growth is one that tries to integrate what are essentially the two fundamental mechanisms. One that has been highlighted by the neoclassical model of growth, which is to say that growth essentially depends on the accumulation of fundamental capabilities. Two of those fundamental capabilities in particular are human capital, education skills, and the other one is institutions, governance, the improvements of the rules of the game in the economy, but there are other capabilities too. So, much of the growth theory focuses on fundamentals and the accumulation of those fundamentals to derive growth. But there's another strand that goes back to Sir Arthur Lewis. In fact, just yesterday at LSE, we were commemorating the 100th anniversary of his birth. And that second strand of thought focuses on essentially structural differences, dualism in the economy, the idea that, in fact, some parts of the economy, even poor economies, have islands of high productivity. That is, that these poor economies are not undifferentiated masses of low productivity all over. That some parts already have accumulated high levels of capability, and that if you think about it again in a very stylized way, these economies being divided into a traditional and a modern parts, then you get a second channel that's going to drive economic growth, which is a structural transformation channel. That is a movement of labor and other resources from the traditional to the modern part. And the policy challenges of fundamentals-driven growth may be overlapping with the policy channels of structural transformation, but they better kept apart. In fact, even though they're overlapping, they're not one and the same. And in particular, that many of the countries that have relied on very rapid structural transformation driven growth have actually, where the accumulation of fundamental capabilities have lagged behind the stimulation or the igniting of structural transformation. The equation that you see there, just sort of trying to summarize that and integrate that, is basically just saying that that there are economy-wide capabilities that derive convergence, but there is also a structural change, the movement of resources from one part of the other to the one part of the economy to the other. Now, when we talk about the modern part of the economy, we often have in mind industry, and in particular manufacturing industry. And manufacturing, at least sort of organized formal manufacturing, is the archetypal kind of formal modern sector. And so I want to say a little bit about the role of manufacturing and why, in fact, manufacturing is special, what makes it modern and what makes it the driver of growth as it expands and draws resources from the rest of the economy. The I think there are three things that make manufacturing special. And these points are going to be particularly important when I go and talk then about the role of services, because I think some of the differences with services is going to be critical. The three elements of manufacturing that I think make it special is one is that large parts of manufacturing tend to be technologically dynamic compared to the rest of the economy, that they have different technological characteristics, that they tend to be on a sort of a productivity escalator in the way that much of the rest of the economy isn't. One way of making this point formal, statistically formal, is to actually look at sort of what the process of productivity convergence in manufacturing, and it turns out that unlike in the economy as a whole, within organized formal manufacturing, there is in fact unconditional productivity convergence across the world, which is really a striking finding. It says it doesn't matter whether you're in Ethiopia or in Zambia, whether you have poor institutions, bad geography, lack of skills, if you're producing in a formal organized manufacturing sector, the further you are from the productivity frontier, the more rapid will productivity growth be. That's a property of manufacturing, formal manufacturing, that economies as a whole do not exhibit. And therefore, this aspect, the productivity dynamics aspect of manufacturing, means that the more of your resources you can get into the formal organized manufacturing parts of the economy, the more rapid will the overall rate of economic growth be due to the more favorable productivity dynamics in that sector. The second point, which I think is extremely important, is the fact that traditionally manufacturing has also been a sector that has been able to absorb a lot of the unskilled labor which these economies have an abundance of. So it's not like you're mining. Mining is a sector where productivity is extremely high. But the point is that you just get a few thousand people into mining, and that's about it, because the kind of is typically very skill and capital intensive. And traditionally, what has made manufacturing such a powerful engine of growth is that it has been able to absorb a lot of workers off the farm or out of informality without putting a lot of requirements on the economy in terms of developing basic capabilities, so that in terms of the fundamentals part of the picture didn't need to necessarily come into play. And the third aspect, equally important, is that manufacturing is a tradable sector. What that means is that you can actually develop just a few segments of manufacturing, garments, footwear, car seats, whatever, and that just with a few of these segments can essentially expand, can scale up without running into a kind of a demand constraint, because after all you're exporting it on world markets, and that means that you can specialize just with just a few successes. If you can get just a few manufacturing industries to work out right, you can keep on going, you can expand and absorb employment without running into a profit squeeze or the manufacturing sector's terms of trade turning against it, as it would if it were limited by a domestic demand constraint. All of that makes the manufacturing sector, I think, has been why it's been traditionally so critical in terms of driving very rapid growth in countries that focus on export-oriented industrialization. And indeed, when we look at the experience of, this would be my one-page summary of the recipe of successful economic policy, a modicum of macro fundamentals. You want to have a certain amount of macro stability, a business-friendly or a market-friendly policy regime. Not a whole lot of, I'm not talking about laissez-faire, I'm not talking about classical liberalism, I'm talking about just basically sort of investment promoting policy regimes. And at the very bottom of the list, a global context which is sort of development friendly, that the rich advanced countries are fairly open, so that they can absorb the manufacturing export surplus of those countries that are able to get onto this productivity elevator. But the key thing that's sort of circled there is that almost all cases that have been sort of experienced, and most of them, not all, but most of them are in fact in East Asia, as we know, have followed a set of policies that the express purpose of which was in fact to stimulate the expansion of these export-oriented manufacturing industries in ways that often differed. Some of them did it through credit subsidies, others through tax incentives, others through special economic zones, yet others through undervalued exchange rates. The instruments may well have differed, but they all had the critical feature that they were promoting these modern manufacturing industries. Okay, so what I want to turn to now is sort of to some empirical evidence that suggests that this model, or this way of looking at economic growth will suggest that the kind of manufacturing and growth through manufacturing, manufacturing-led structural transformation opportunities are going to be fewer and rarer in the future, is to look at what has been happening to manufacturing around the world in recent decades. So we all know that there is some kind of a manufacturing curve over the course of development. That is, that if you look at manufacturing as countries get richer, the importance of manufacturing rises, then past a certain point it tends to fall. So here I have three different measures of manufacturing. Sometimes when we talk about the importance of manufacturing, we sort of conflate these three. It's going to be very important that we keep them apart. One is the share of employment in manufacturing, and the other two are the share of manufacturing value added in GDP, one of them at nominal prices, the other at constant prices. Okay, so the one at nominal prices, probably the one that one looks at most frequently, is probably the least important. So this is the last time I'm going to show you anything about that. So the two key ones are going to be the measure of manufacturing in terms of employment, as a share of total employment in manufacturing, and a measure of manufacturing value added at constant prices. Okay. So what you see here is that if you look at those two, you see that there's a very definite inverse U-shaped relationship with respect to manufacturing employment, as manufacturing employment rises and then falls. With respect to the share of manufacturing value added at constant prices, there's still a sort of something that looks like a concave curve, but in fact the turning point comes very, very late, if at all, in the development process. And I think people have sort of missed that because they tend to look at nominal, the share of nominal value added, and because the relative price of manufacturing tends to go down, you have this turnaround happening in nominal share of manufacturing, but often actually not in terms of real manufacturing. Okay, so what I'm interested in this is what has happened to this relationship over time. So just to to think about it in graphical terms, and just to take one point in time, look at what has happened to this curve before and after 1990. Okay? And so here, for example, is the share for the employment measure of industrialization. And the two curves here are for the dashed blue one is for the period before 1990, and the red one is for after 1990. And what you see is very definitely that this curve has shifted down and closer to the origin. Okay, what that means is that at every level of, or what's clearest here is that in fact the turning point in terms of where deindustrialization sets in happens much sooner. It looks like at low levels of income, you're getting more employment manufactured, but that's a little bit of an artifact of the functional form. I'll show you some results where, in fact, that is not the case. Similar kind of a situation with respect to output, and in fact, if you look at output of manufacturing, now you see a definite turning around point happening much earlier. So this is in terms of post 1990. There is definitely this turning point. So let me. It's a little bit. You know, I've shown you this for post and pre 1990. You might be tempted. You might think that there's something special about 1990, but it turns out that actually this is a secular trend that has been happening for quite some time. And it's not simply a pre and post 1990 phenomenon. So this next one, I don't know if you can actually read these numbers. If you're, I guess, sufficiently close to the screen, you might be able to. So the next set of numbers is really is a set of estimates of the estimate of controlling for everything else. That is controlling for income and demographic trends. What have been the time trends on manufacturing in different decades. So this is going 60s, 70s, 80s through the 2000s. So obviously the 1950s is the excluded decade. So this is all relative to the 1950s. And also the advantage of these numbers is you can look across different kinds of countries, different geographical regions. So when you see this, what you see, if you look first at all countries, is that in fact there is a secular decline in manufacturing employment as a share of total employment that is really has been going on before 1990 as well. So that by the 2000s, this is an incredibly large number, by the 2000s, the share of employment in manufacturing, controlling for everything else, is more than 10 percentage points lower than what would have been the case back in the 1950s. This is for all countries. Now, there is some interesting differences across regions. That is, when you look at, this is the case certainly for the developed countries. So developed countries have been losing workers. But if you look at sort of the developing country regions, it's extremely strong in Latin America, does not exist for Asia. So there's no downward trend in the Asian cases. For sub-Saharan Africa, if you exclude Mauritius, there's about 10 sub-Saharan African countries here, so excluding one country makes a difference. If you exclude sub-Saharan Africa, which is the final column, you also have a decline over time in the manufacturing share of employment, albeit at a slower rate than what we've observed in the advanced countries and in Latin America. And of course, the fact that exclusion of Mauritius makes this difference should alert you something. Mauritius, of course, has been a major exporter of manufacturers, and that's what's throwing off the results. But if you exclude it for the rest of Africa, we have this time trend. This is with respect to output. What I had shown you before with respect to employment. Now, with respect to output, what's interesting is that, in fact, developed countries, the advanced industrial countries, have not experienced a trend decline in output. They've experienced a trend decline in employment, but not a trend decline in output. Latin America, very large trend decline in output. Asia, actually a trend increase in output. In manufacturing. Once again, in sub-Saharan Africa, excluding Mauritius, another trend decline in output, albeit at a slower rate than in Latin America. Okay, so these are the effects on a country-by-country basis. If you look at sort of where the decline in employment is coming from, it's coming exclusively from the decline in the ability of manufacturing to absorb very low-skilled labor. So that if you disentangle the employment content of manufacturing into three skill categories: high skill, intermediate skill, and low skill, it's only the low skill employment that has been coming down. And that over time, there's no large trend effects for the other two skill categories. So it's really the decline in employment has been concentrated in the low skill category. What that means is that now if you look across countries, there's this phenomenon of premature deindustrialization. It's interesting that premature deindustrialization was a term that was first used in the British context, that when in the 70s, I believe, when Britain began to people began to worry about deindustrialization in Britain. But of course, I think this is much more worrying in the context of the developing countries that have not yet exploited their potential comparative advantage in manufacturing. And what this shows is that in recent years that countries have been reaching their peak levels of manufacturing employment at lower and lower levels of income. So they're starting to deindustrialize at much lower levels of income. Now, what is explaining this? I'm going to actually skip some of the analytics here and just come to what I think is the two key trends that's driving this. One is that in terms of employment, the nature of technological progress, which has been much more skill and capital intensive over these periods, means that for any sort of constant dollar output of manufacturing you're producing, you need to use less labor. So this has been across the world sort of a factor on less labor use, particularly of the low skill type in manufacturing. But that on its own does not account, for example, why Africa or Latin America have lost so much output. Because that's an explanation for the decline in employment, the upgrading, the skill upgrading of manufacturing, but it doesn't explain the decline in output. In order to explain the decline in output, you also have to add the assumption that global markets have become much more competitive. In particular, the presence of a set of successful exporters, Asian exporters, have basically driven a lot of the developing countries out of these production out of these markets. So if you divide the countries into a set of countries that are exporters of manufacturers and are not exporters of manufacturers, there are very clear differences. You got a hint of this before when we looked at Asia, where these deindustrialization trends are much less evident in Asia. But you can just divide these countries by whether they're manufacturers, exporters, or not. In other words, they started out with a strong comparative advantage in manufacturers or not. And those countries were able to avoid significant employment deindustrialization, and with respect to output, they were able to avoid output deindustrialization as well. So all this is really happening for countries that were not strong exporters of manufacturers. So the story is basically something like this. Technological changes everywhere hurt employment in manufacturing, unless you had a very strong comparative advantage in manufacturers. And if you had a strong comparative advantage in manufacturers, the employment effects were moderated, plus you could even get some positive output effects. And countries like the Latin American countries and African countries, in some sense, were the recipients of a double whammy. On the one hand, they received the relative price implications of the very rapid technological progress in manufacturing from the north, which meant that relative manufacturing became relatively less profitable for them, even though they were not the source of that productivity increase. At the same time, they were now facing much more competitive threat from countries that have very strong export potential in Asia. And so that meant that the process of the industrialization and the headwinds that manufacturing industry was faced became that much stronger in those kinds of countries. So it's really a story, if you will, of very divergent patterns that globalization created. If the first wave of globalization before 1913 was responsible for a great divergence between the North and the South, based on sort of the North specializing on manufacturers, the South specializing on primary products. The more recent, the post-Second World War period, has been in some sense responsible for a divergence among the developing countries. The Asian countries that took earlier advantage of these export potentials benefited disproportionately. Now, what all of this means, I should say just a few words about global value chains, and this is literally will be just 2 sentences, well, something like this, that we think that there's something very counterintuitive about sort of what I've said, because after all, we live in a world of global value chains. Isn't this the kind of world where, in fact, it should be a lot easier for countries to industrialize? But global value chains are a very mixed blessing from this perspective, because even though these value chains have made it easier for any country to enter manufacturing at any particular segment, at the same time, they basically have disconnected these segments from the rest of the economy. So countries like Korea and Japan and Taiwan, when they industrialized, they built entire industrial complexes. And now, basically, you're just producing one segment, one narrow segment of these value chains. And so, and plus, with respect to product specifications that require high use of skill and capital, and therefore are employing much less labor than before. So we see this, we can't really make out this number, but that basically the domestic value added component of manufacturing has been shrinking all over. And that's that's contribution of these growing spread of these value chains. So what that means, if sort of graphically or sort of in a very just to summarize, is that we had a typical pattern of structural transformation and growth. That countries went basically from agriculture, where informality was dominant, they went to manufacturing industry or formal manufacturing industry, and after that they would move into services. This is sort of the classical pattern. What's really happening today is something like this, which is that countries are moving basically, most of the labor is moving from one type of informality to another. Albeit now in urban areas, in services where, in lots of petty services where their productivity isn't necessarily much higher, and very small bits of labor going into organized formal manufacturing activities. So that leads me to be somewhat pessimistic about the prospect of industrialization in the years ahead. The question is then going to be, sort of what does that mean in terms of growth strategy? Are there similar opportunities with respect to services? And if so, what might be the equivalent of industrial policy for services of the sort of the traditional industrial policy of the various kinds that I briefly summarized in manufacturing industries? So I'm just going to say a little bit, a few words on services, just to highlight some of the special problems that services raise in this regard, and just go rather quickly through some of the other things. I just want to stress here why services are not like manufacturers. That in a stylized way, you can think of services in developing economies being made up of 2 types of services. On the one hand, you have a bunch of high productivity and tradable segments of services, but those are typically actually quite skill-intensive part of the services. So if you think about business services, finance, insurance, and sort of the banking services, those are tradable, high productivity, but their skill requirements are very, very, very high. So they're not going to be able to absorb much of the economy's labor force. On the other hand, the bulk of employment is in low productivity services, and these are largely non-tradable. And the difficulty, because they are non-tradable, is that it's very difficult to increase productivity in any one segment without eventually that segment running into a profit squeeze if at the same time productivity in all the other services is not increasing at the same time. So what that means is that it's not pushing us back again towards that sort of fundamental capabilities channel, where you basically have to accumulate these capabilities across the entire economy, across the entire swath of services, and it's no longer going to be enough to successfully just move into individual manufacturing activities and have very rapid specialized productivity growth. So let me just show you a couple of charts that shows you first in terms with respect to the dualism in services, the productivity differential between services such as wholesale and retail trade and community social and personal services where informality dominates against some of the more formal services, and there's a big productivity gaps. Similarly, with respect to firm size and organizations, that if you look at within sectors, and this is just for the retail sector, if you look at productivity gaps, there's a very large gap between the modern and the traditional segments within sectors such as in retail. And unlike in the developing countries, most of the employment is actually in the traditional segment, and so the issue here is going to be sort of how are you going to address these? Are you going to address this by helping small firms grow? Are you going to address it mostly by actually targeting the already well-established modern firms so that allow them to expand to at the expense of the smaller traditional segment? You're going to do that by enforcing formality, by deregulating, by bringing in FDI. Now, one of the conundrums here is that in principle, it seems that we know a lot of things about how to increase productivity in many of these service activities. For example, in retail, McKinsey says prescribing many of the measures that are needed to improve productivity in traditional enterprises is straightforward. And I'll give you a list of 20 things that you can do to improve productivity, operations, and so forth. The problem from our standpoint is that almost always when you do those things that are going to, on the McKinsey list, it's going to result in a reduction in employment. And so we have this sort of distressing result that if you look across countries in service industries and ask what's the relationship between productivity growth and employment absorption, that the more rapid productivity growth in the service industry, the more they have lost employment. Or I haven't put this very, very well, but those service sectors that have absorbed a lot of workers have lost out in terms of productivity, and the only ones that have actually gained in terms of productivity are those that either have not absorbed labor or in fact have lost labor. So there's this trade-off. You can have the productivity, but they're not going to then have your workers going in there. So then the whole question becomes, where do those workers then end up? They end up again in other sort of informal and low productive activities. Now, why is it that manufacturing actually was able to evade this trade-off? And here, the obvious response is that the key here is tradability. That if you're a tradable industry, when you're increasing productivity, you can simply scale up. You can increase productivity. You can increase employment because you're selling on world markets. You're not running into a demand constraint. Whereas in services, basically increase productivity. You increase output, but that's coming at the expense of reduced prices. So you're sharing the benefits with the rest of the economy, but also is putting a brake on how much more you can expand. So this is a serious issue that the slowing down of the kind of product growth driving structural change. The fact that this engine, the traditional engine of that has driven economic growth, has lost steam. You can see it in all kinds of data and evidence. I'm running out of time, so I'm not going to be spending a lot of time here. But basically, even in the sort of the relatively high growth period after the 1990s, what you see is that across countries, structural change has actually been a drag on the economies of these countries. So that it's that on balance, in fact, labor has been moving in the wrong direction, rather than moving from low to high productivity activities in the way that the traditional Lewis model would predict. Labor has been moving from higher to lower productivity activities. And if productivity has increased overall in these countries, it's because of productivity growth within sectors. But that structural change actually has contributed negatively. So let me just conclude. Going back to the original framework. So the original framework said that, look, there is a fundamentals channel, so that's everything in that theta, so all those fundamental capabilities that determine your long-run steady-state level of income. That's sort of the channel that is A. That's a fundamental driver of growth. The problem with that is that typically that makes for a low growth. You need to you invest in education, you invest in your institutions, but that's not going to give you East Asian kind of growth. That's not where East Asian growth has come from. Alternatively, you have the channel B is the productivity dynamic in your modern sectors. The problem with that is that that's weighted by the share of the modern sector in your economy, and that being very low, that alpha M is the share of your modern sector. That doesn't contribute a whole lot to growth. So in the early stages, that doesn't give you very rapid growth for the economy. Where the structural change channel is the C one, where basically is the shift of resources from low to high productivity activities, where pi is the relative productivity of the modern and the traditional sectors, and that is the structural change channel. And that's the channel that I've been concerned about in my talk. So basically, logically, in terms of thinking about how you might have higher growth against the kind of background of the things that I've talked about, is you can think about are there ways in which we can actually increase the return to the investment in the fundamental capabilities? So just increase return on investment and in human capital and skills and institutional capabilities. I have no idea how to do that, but that's logically one of the ways. And the other is simply to expand the range of industries with escalator properties. So there's that look for service activities essentially that can act like manufacturing. And so those are two sort of generic kinds of strategies. So I end with somewhat a pessimistic note. That when I look at what's been happening, my baseline for economic growth, what is sort of what's the rate of economic growth that we can expect developing countries, low-income countries in particular, to sustain over the medium to longer term, is significantly lower than what has been the case in the last 15 or 20 years. That there were very many special circumstances of the last 15, 20 years, cheap capital, lots of foreign aid, recovery from civil wars and macro crises of the past and so forth, that basically they have run out, and therefore what we're going to be getting to is in some ways much more of a a neoclassical type of growth where you're going to be getting relatively low growth simply because basically it takes a lot of time and investment for these basic improvements in capabilities to show up in real GDP. So maybe growth rates per capita between 2-3%. That's not necessarily a very bad thing, but it's still half of what a lot of countries in Africa recently had. But I just don't see where that dynamism is going to come from in the absence of the kind of the structural change engine that has been so important in other countries. So let me just stop this.